What's up guys, Jake here. Lots of people in the comments section have been asking me for an update on my dead hand options trading strategy. So in this video, let's kind of reset the board and start an official challenge for it. I have been testing it the last couple of months, however, I wasn't really keeping good records of what I was doing, plus I was adding additional funds. So let's just reset the board and start over. In the event you didn't see my first video explaining what exactly is the dead hand options trading strategy, check that out. That will go into greater detail to help you understand what it is exactly I'm doing in my Fidelity account for the rest of the year. And finance YouTubers like to talk about paper hands or diamond hands. I'm talking about dead hands. I want an options trading strategy where I don't have to do any technical analysis or quantitative analysis or qualitative analysis. And the dead hand options trading strategy is reactive, not predictive. So I'm just responding to whatever the market does. And ideally, it should be automated. I don't have a computer program to automatically do this for me, but in theory, if you knew how, you could set this up to automate it. Now, this is a very high-risk options trading strategy. I am not recommending this to you guys. If you want to, this is not financial advice. I am not your financial advisor. You assume your own risk. However, I do believe that if done correctly, I can earn between $50, $100, $150 every day the market is open, which is a pretty good rate of return. And the ETF we're going to be trading options on is SPY. This is State Street's S&P 500 ETF, and this is kind of becoming a rich ETF at $427 a share. The share price affects the option prices. If you're looking for another good ETF to potentially try this on, you can go with Vanguard's VOO or VTI, BlackRock's IVV, or Invesco's QQQ. Their share prices are a little bit lower than State Street. And to recap the strategy, step one is to buy shares of SPY. And this was a very frequent comment in the last video of Jake, why are we buying shares of SPY? And I didn't really explain it, but if you're doing this strategy with $20,000, $30,000, $40,000 in your brokerage account, you want that money doing something, not just sitting there as cash. And buying and holding the S&P 500 index fund is already a good strategy long term. It doesn't involve options, but you want to be buying shares of SPY so your money is at least in the market. You're collecting dividends, you're collecting capital appreciation as the S&P rises. That's why you're buying shares of SPY. And step two is to buy a just out of the money call option. This will be your level one. And what you're doing here is you're buying one contract at level 1. If the market is red the next day, you double up. You go to 2. If it's red again, you double up. You go to 4, 8, 16, 32. And anytime the market then snaps back or goes green, as long as you can sell all your call contracts as one position for a positive, you reset the board, sell all your contracts, deleverage, reset, start the what I call the SPY call ladder again. So level 1, it's one contract with a roughly 2-month expiration, double to 2, and then you double to 4. Now for this SPY call ladder, for this to work, you need as many levels as you can afford. So I'm budgeting for 6 levels. So the market has to go down 6 consecutive days a lot without there being a dead cat bounce or a snapback to get out of your positions. Once again, when you're buying 32 call contracts at the lowest level, you're trying to recoup all of your losses from the previous 5, plus still make a profit for the day. Now, the total cost of this is pretty expensive. So this is a very capital-intensive options trading strategy, which is why it can't be for everyone. I'm sorry, guys. And if you want to risk it, you could just cut out the last level and only have 5. But once again, you're running that risk. So step 3, like we talked about, anytime you can sell all your call contracts and deleverage for a profit, do it. Do not be greedy. Do not hold another day. Additionally, if you have 100 shares of SPY in your account, you can start selling covered calls. And selling covered calls on an index fund is already a good options trading strategy. Collecting that premium every month from theta decay and volatility decreasing in the market if it does. Now, obviously, sometimes your shares will be called away, but ideally you just want to keep collecting that premium every month, and I'll show you an example how much money that is in a second. Now, as I was testing this strategy the last month and a half, I was actually getting pretty frustrated because the market was green a lot in June and July. You'll notice here 1, 2, 3, 4, 5, 6, 7 consecutive green days. And originally I was thinking, well, you have to wait for a red day before you buy your first call contract. Yes, you're still holding shares of SPY, so you're still gaining value in your account over these 7 green days, but it's pretty frustrating not buying your first level of call contracts. So I'm amending my strategy just a little bit here, and what I want to do is always have a open call contract on level 1, even if the market is green. So if the market is green 5 consecutive days, what I'm going to do is always have a level 1 call open. So this one was from the day before. I'm going to sell to close it, then buy to open a new one, probably for the same expiration date, but a higher strike price, because this call contract is now ideally in the money. If I'm always buying to the dollar, the closest strike price out of the money, then just a little bit of price movement is enough to push it in the money, sell it for a profit, maybe it's 30 bucks, 50 bucks, whatever, and then get into the next call with a higher strike price out of the money. So I'm doing this every day. Every day the market is green, I have one call contract on level 1 that I am selling to close and then buying to open the next one at a higher strike price. So what does this look like now when we have consecutive red days? Well, this day was green, so I opened a new one. The next day is red, so I can't sell to close it. And I then go to level 2, buy 2 call contracts. If the next day is red, I then double up again. I'm now opening 4. If the market is red again, I then double up and go to 8. And it's only on the next green day where I can sell all my call contracts for a profit that I deleverage, exit my position, and then I buy to open another call contract for the next day. So by making this amendment to my strategy, I will always have a call contract capturing price movements, even when, there's 5 consecutive green days, 6 consecutive green days, 5. Like, there's just a lot of times in the market where there's just a lot of just entirely green weeks. Now, additionally, I think in previous videos, I really oversimplified what is a red day and what is a green day. It's not as clear-cut as this because the market is fluctuating even intraday. There can be 1 to 2% swings up and down within a given day. These candle bars you're looking at, whether it's red or green, is a reflection of the price at market close. So this is not a good barometer of what your call contracts are doing. We need a concrete number, guys. So I got one for you. So here is an example in my Schwab account, which I'm also doing the dead hand right now. And I bought this call contract yesterday, or this was from a while ago, but the market was only slightly red. And my call contract, the value, the total profit and loss or unrealized losses, it was only down 12%. And in my opinion, that's not enough to justify doubling up to going to level 2 and buying 2 more call contracts. So you can decide whatever number you want to do if you're trying this, but I am going to set a hard and fast rule here that if the previous level the value of the contract hasn't dropped by 20%, I'm not going to double up. I'm just going to pretend like that's a neutral day, doesn't count. I'm going to wait for the next day. So if my total position in my previous level's call contract is not down 20%, then it's a neutral day. I'm not buying or selling. Don't double up, and don't deleverage. So it's just a neutral day. You can pretend like it didn't happen. Wait until tomorrow. So to recap, let's say there was a huge red day of 3%. You doubled up from a previous level, and then a red day where the market is only down 0.1%. Just ignore that day. It's a neutral day. It didn't happen. Same thing if the market is only slightly green. If it's not enough to recoup your losses and get out of the total position of all your call contracts, once again, treat it like a neutral day. Do not double up, do not get greedy. And this actually basically condenses the calendar. When you go back through history and you find consecutive red days of 6, 7, 8, 9 consecutive red days, well, now you can ignore days where it's only slightly red. However, anytime it's consecutively green like this, you're still being taken care of by constantly jumping in and out of those level 1 call contracts. I'm sorry if I'm making this confusing for you guys. I definitely do tend to complicate things. However, I've got a lot of money at stake, so I definitely want to put some thought into what I'm doing. So here's my plan for the rest of the year in my Fidelity account. I sold everything. I reset the board. I'm starting with $87,000. The reason why is because that is enough to buy 200 shares of SPY. So I'm starting this new dead hand options trading challenge in my Fidelity account on July 15th with $87,000. And I'm going to do this through December. And I want to see how much money can I make doing this over roughly 5.5 months. Pretty interesting. So to set up my account, let's first buy 200 shares of SPY. And you'll notice it says pending activity $20. So after I bought all of my shares of SPY, I have about $20 left over. First thing I'm going to do in my account is sell covered calls on my 200 shares of SPY. If you're not familiar with selling covered calls, check out those videos on my channel. Here is the option chain for August 20th. This is roughly 1 month in the future. I'm always going to buy and sell options on the third Friday of the month because those always have the most trading volume. And I want to sell this covered call roughly 1 month out because theta decay is greatest, so 36 days is my time horizon for August. I'm selling these in July. And I have delta showing here on the option chain, and we want to go down to a delta value roughly of 30%. So ideally, 70% of the time, I'm not getting my shares of SPY called away, but 30% of the time, according to the Black-Scholes formula, I will. So I'm choosing a strike price of 443, and it says I can get an options premium. I can be paid from a buyer $291. Now that's almost 300 bucks, guys. And I'm going to be doing this twice in 1 month. So 200 shares, 2 covered calls. That's almost $600 for 1 month. Multiply that by 12 months, and I'm making about $6,500 just by selling covered calls. This is guaranteed premium. Obviously, the shares of SPY can go crazy up or down. I could lose 30% of my account value, but I'm guaranteeing myself almost $6,500 in premium just by selling covered calls on these 200 shares of SPY. That's a really good return. So now in my account, I have the 2 covered calls sold. You'll notice I sold them because it says -2. Do not confuse your calls sold with your calls bought because everything is on SPY here. And it says current value -574. So if SPY just trades perfectly sideways over the next 36 days, the value of this will go to 0. I won't have my shares called away. I won't have to buy to close it. And the money is technically in my accounts. So you notice under pending activity, this was basically my free cash. It was $20. I'm now at $596. So you are paid the cash. However, your covered calls still have negative value until theta eats away at them and they waste away. Next thing we have to do now is buy the first level of covered calls. And because I'm starting with so much money in my accounts, my level 1 is actually going to have 2 call contracts. So let's first look at the option chain. And once again, I always go with the third Friday of the month. And when I buy calls, I'm going to be going 2 months out. So the current month is July, August, September, go forward 2 months. So this is 63 days in the future as the expiration date. And I'm always going to choose the closest strike price out of the money. The blue is in the money, the white is out of the money, so I'm going to choose a strike price of 436 for my 2 call contracts. Now, obviously, this is a screenshot, and I actually waited a day to buy these 2 calls, so the market is up slightly, 0.26%, which is why I'm now at $87,200 in my account. But here are the 2 call contracts for level 1 that I bought, and when we look at total gain loss, just check out this percentage. If this gets below 20% by tomorrow, I'll know to double up and go to the next level. And then that level has to get negative 20% in value before I then double up again the day after. So once again, let me just quickly help you visualize what exactly is happening with your SPY ladder. And if you're doing this with $20,000, $30,000, $40,000, then you start with your level 1 at 1 call contract. Because I've got $87,000 in here, I'm going to start with 2. I'm basically doubling everything to have 6 degrees. So if the market crashes and burns, I'm going to be going up to 64 call contracts. And remember, this level, the value of these has to go down by greater than 20% before doubling up, doubling up, doubling up, doubling up. And as soon as there's a dead cat bounce or a snapback and I can deleverage, sell everything for a profit. Doesn't matter if that profit is only $50, guys. Sell everything, deleverage, reset the board, go back to 0. That's how you stay alive with this options trading strategy. Okay guys, I'm pretty excited to give this a go. Once again, I'm going to be recording and documenting everything that happens in this account over the next couple months. I won't have frequent video updates. Maybe if I get to like level 4 or 5 and you guys want to see me being crazy, I'll do a video update, but there's not really a whole lot to report. If the market is green, just assume that I've made about $50, $100, $150 on my level 1 calls before I sell to close, buy to open new ones. Yeah, I'm hoping for the market to be green, but even if there is consecutive red days, as long as it doesn't bust me by the market dropping 20% and then trading perfectly flat, I'm willing to risk this, and this is entirely risky, guys. So once again, guys, I am not advocating that anybody copy what I am doing or adopt this strategy. I am the guinea pig testing it out over the next 5 or 6 months. If it goes horribly wrong, I will document that for you, make a video, hopefully recoup some of my losses by making a video saying how I lost all this money. I don't know. We'll see where we're going with this. I think it's interesting. I think it's a lot of fun. Once again, I'm trying to be lazy here, guys. I'm trying to find an options trading strategy that doesn't require me to pay attention to the markets or try and predict the future. And I like this strategy. It seems intuitive to me. I'm going to give it a shot. We'll see where it goes. If you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.